And good afternoon to all of our friends and clients in the East, and good morning to all our friends and clients on the West Coast. This is Larry Shavaro, Executive Vice President of First Associates, and welcome to our 8th webinar in our Successful Alternative Lending Strategies series. Today, we have some really good content, FinTech student loan servicing, and we've developed this webinar from requests from our clients who want to know a little bit more about more of the FinTech flavor in student loan servicing versus the old student loan servicing approach. A couple important announcements. We will be taking questions throughout the webinar. The webinar should run no longer than 20 minutes in total. We like to keep them quick. We find that many of the folks who have joined like to stay on. Right now we have over 200 folks that are online with us. All of the webinar and past series are on our website and on our YouTube channel. At the end of the webinar, there'll be a survey. If you would take a minute or so to fill it out, that helps us create new content. And we have a chat button, and so you can chat your questions to the host, and we'll be able to answer some questions at the end. If we don't have time for all of the questions, we'll answer them and send them out. And yes, we will send you a copy of the slides at the end of the webinar. Rose, next slide, please. Here are some upcoming events that First Associates is very involved in. We have the Marketplace Lending Summit in Dana Point in the beginning of December. As well as on December 7th, the Southern California Consumer Finance Professionals Group, which is our group that we've created at First Associates with many folks in Southern California, is having our quarterly meetup and holiday event in Carlsbad. If you'd like to sign up for that, you can go to the meetup site or send us an email and we will have you added to the list. It's a free event, a great networking opportunity. iBig is hosting their second Marketplace Cloud Lending Conference in Las Vegas on January 19th and 20th. And here's one we're really excited about, the Context Alternative Lending Summit in Miami. First Associates will be moderating the Marketplace Lending Panel, and the registrations for this event is coming in real strong at this point. And then we will be at SVIG, which is the ABS Vegas conference, once again at the end of February. Next slide, please. A little bit about First Associates. We are the largest third-party loan servicer in the United States. We service many different assets, whether it's loan or lease or student loans, marketplace lending, auto, power sports, and all assets except credit card and mortgage today. We provide primary servicing, which is everything from onboarding, billing, payment processing, customer service, collections, repo, and remarketing, as well as backup servicing for securitizations, warehouse and debt facilities. We provide contract verifications, custodial, paying agent, and collateral management services. Next slide, please. These are some of our clients that we work with throughout here, not only in the U.S., but we also do some work in Canada and the U.K. as well. Next slide, please. And it's my pleasure to turn this over to David Johnson, who is the CEO of First Associates. David's going to share some items around FinTech loan servicing for student loans. David, take it away.
Thanks, Larry. Just as a preamble, when I talk about student loan servicing today, we'll be talking about how it contrasts with legacy student loan servicing, which is how the majority of student loans are serviced today, and some of the requirements for servicing some of the newer FinTech style student loans, which are generally refinancings of what's already out there, as in SoFi or Common Bond or other newer companies that are doing it in a different way. So First Associates has been in the student loan servicing business for about 8 years. And just given that time frame, you can tell that we started at a time when there really wasn't a significant FinTech industry back at the beginning. And what we found out at that time was very clear. We were working with other legacy providers in an environment that was powered almost entirely by all the companies that many FinTech players are trying to displace today. And so we have a few kind of key takeaways from starting from that time and going forward. Next slide, please. And the very first one is about information management. In managing consumer loans and in managing student loans in particular, information management is everything. You simply cannot build anything without having a strong, solid grasp of your information. You're just building a castle on sand if that's the case. So often in the old world of student loan servicing, we would find that the information was flat out terrible. The quality was bad. The relevance was questionable, and it tended to be very dated. So having a platform that can manage that information and do so in a scalable fashion is a key competitive advantage in student loan servicing. And that information comes from a variety of sources. It comes from the consumers or students themselves with the updates that we receive from them. It comes from the origination platforms, which tend to be specialized in the student loan space, from the credit bureaus, from the payment processors, the banking system. It comes from, in student loans, from enrollment warehouses in schools, which are particularly difficult to get quality information from. There is a student loan enrollment warehouse that holds all the enrollment information regarding student loans, and generally what we found is that the information is outdated. It's not corrected, and it's very difficult to get a clean set of information. And enrollment information for student loans that are not refis is a critical piece of information because of the way the loans are structured, with a grace period, with in-school periods, with different types of repayments that are wholly dependent on a student's enrollment status. We are also picking up information from schools, whether that be in-school information about the student status vis-a-vis enrollment and expected graduation date, which plays a very important role in starting the loan and making sure the payments start on time, or adjusting an in-school payment to a then graduated payment. Many schools differentiate heavily between those students that graduate and those students that drop out. So that information flow is an important one. Post-graduation, it's an important information flow to make sure that you can keep tabs on where students are. Students are, especially recently graduated students, are not as likely to have information resident in the credit bureaus or in the kind of traditional skip tracing bureaus. We use many of the school relationships that we have to help us keep tabs on students, student borrowers through the alumni networks. And then obviously there's information flows from various vendors that one would use to do skip tracing, and a lot of information flow out to investors. And the information flow out to investors in student loan servicing tends to be of a different flavor than straight consumer loan servicing because of the additional statuses and the complications having to do with the enrollment status, in school, out of school, grace, deferment, et cetera, et cetera. Next slide, please. With students, it's also important that particular attention is paid to the communication and how that communication is made, when that communication is made. Consumer preference plays a large part in making sure that these student borrowers actually receive communication. So I think we all have had well, maybe we haven't all had the experience, but I certainly have, is I can call my son who's in college 1,000 times and he never picks up, but one text and he's right there. And the same is true for student borrowers. It's not wholly dependent on text, but there is a fairly massive drop-off in the type of reaction that you will get from a traditional letter or a phone call versus a text or an email. And so getting the channel right is critical in student lending. If you're not sending text, you're probably missing out on a considerable part of that communication opportunity. Likewise, student borrowers or recently graduated students tend not to have a very strongly fixed home address, so any mode of communication dependent on knowing where they physically reside tends to be weak. The content of the messages needs to be a little fresher. It needs to be something that is still well within regulatory bounds, but can be a little bit more geared towards a younger audience. Obviously, the regulations are geared differently for students. There's an entirely different set of regulations when it comes to student loans, which need to be paid attention to and make sure that you adhere with those. And all that rolls into your effectiveness of how many right-party contacts you can get on a student loan portfolio and what the portfolio performance looks like at the end of all that. Next slide, please. To create a student loan servicing platform that's effective, that actually can create a performance in the portfolio that really works, you need some really very key capabilities. You need to make sure that as you're building out a servicing platform, you're thinking about data management. So how much data will we have? How will we manage it? How will it be stored? Will it be secure? Will that mode be compliant, et cetera, et cetera? And you need to have some specific capabilities, particularly around the communications methodologies that I mentioned earlier. So you need to be able to text. You need to be able to do it in a compliant fashion. That means going through the FCC approval. You need to be able to send email, which means that you need to have the emails to begin with. Emails can be quite difficult to procure and keep current. You need to have the right set of personnel, and that needs to be a personnel base, a labor pool that can be expanded as you grow. So you don't want to base your operations in a small labor pool like, say, somewhere in a second-tier Portland type of area versus having a kind of more first-tier city like San Diego, like Chicago, where you can actually get a large base of the appropriate types of people. And compliance. You need to have compliance that is not only compliant at the moment, but a compliance that is scalable, a compliance that can be built into the actual platform. Too many platforms today are old legacy platforms where essentially a compliance screen is put on after the fact. So for instance, quick example, if you're calling consumers in Massachusetts, you can only make a couple outreaches per week. Most of the legacy platforms will simply do all the campaign strategy, pump out the campaign, and then there'll be a curtain after that which will catch anything more than 2 times a week, which of course means that your campaign strategy is worthless because it just got chopped by this curtain. Much better to have it built into the actual system where the campaign strategy takes into account that you can only do that twice a week. And there's many of those types of regulatory issues that come into play when you're servicing both consumers and students, where you want to make sure that compliance is built in, not bolted on. Next slide. And you want to have a pretty far-reaching compliance program. So for example, here's what we do at First Associates, which consists of going clockwise, compliance testing programs. And these are internal programs that we use to test compliance with the various rules and regulations with jurisdictions that range from federal to state to county to city. We have independent audit programs, the most widely known of which is an SSAE 16 Level 2, which is a process audit, which some of you will know about ISOs. This is similar to that. Lots of client diligence. So First Associates has many Tier 1 banking clients, and they have their own audit programs and diligence. We also turn the coin on that and for our vendors do the same sort of diligence and management. So you have that diligence outbound into our vendor base. So our entire vendor chain will be compliant. Then a tight management on customer complaint systems. It's very important in today's world, especially with the CFPB, that everyone have a tight grip on how much complaint volume is being generated, how it's being dealt with and resolved, and that there is some form of customer advocacy within the corporation that serves to give the customers a voice within the company so they can have those complaints resolved. And then, of course, the management oversight of that entire system. So this should bubble up to the senior management and the board level. And that's the type of compliance system that you'll want to build into your servicing platform or to expect that your outsourcer would have in order to make that really work. So that's my 4-slide summary of what's required in FinTech student loan servicing. I'm going to put it back to Larry for Q&A. Larry?
And thank you, David. That was very informative. We actually have a whole bunch of questions that came in, and so we do have time. If anybody that's on the webinar has additional questions, please get them in. We'll try to answer as many as we can. I think some of them are really interesting here. The first question that I have is servicing platforms. The question is, many student loan servicers are using an old Commonline platform to try to be a FinTech servicer in student loans. What is First Associates? What platform does First Associates use, and what's the advantage?
Well, I'll say this question is it's much bigger even than just student loan servicing. It's very typical in the servicing industry to use a legacy platform and then to try and somehow make it work by applying a lot of duct tape and paper clips. It's an approach that just doesn't work very well because it doesn't scale. First Associates uses a completely SaaS platform, which we've created by knitting together several SaaS platforms in the cloud, which works very effectively for us, and it creates a level of scalability and flexibility that you just can't match with one of these legacy platforms.
Okay, thank you for that. Another question, what are the typical issues that you see when you take over a student loan portfolio?
The typical issues on a student loan portfolio would be, number one, there's no information that's accurate about the borrower. So typically we'll take over something and it turns out that no one really knows where the borrower lives, what their phone number is, what their email address is, and often even their enrollment status can be in doubt. It's almost every single piece of information post-origination, because what happens is that the loan is made, sometimes long periods of time can go by, it may even be years, and then the student graduates or drops out, one of the two, and then a communication program should start right then and move forward. But since the information is probably inaccurate, the student usually never receives that, and they often don't remember that they even have this loan because it happened so long ago. And so that base level of information is never created. It's never maintained. So there's a lot of work to be done in recreating that information and making sure that all of that borrower information is accurate and timely, especially in the case of the enrollment information. I think the second issue is that when it comes to reaching out to these borrowers, again, because there's often like a long period of time, it gets to a point where they really don't understand what their obligations are. So there's a large kind of borrower education program that needs to be executed in order to reacquaint them with the terms of their obligation to make sure they understand it, and even just the mechanics of how they can pay it, what the options are for paying it, these types of things, but just kind of refreshing it. On the newer refinancing loans, the newer refinanced student loans, on those, usually the issue has to do more with making sure that there's a solid line of communication with the student from the actual refinancing of the instrument, which is usually much shorter in. So there's been a refresh, so that tends to be less of an issue than a legacy loan, but it still usually turns out to be one. And there's often an issue that there's a lot of non-compliance in the refinancing market, and making sure that these loans get bumped back into a compliant position is usually an issue that comes with those loans.
Okay, thank you for that. A question came in regards to delinquencies on portfolios that are taken over. What do we typically see?
You okay there, Larry?
Sorry about that.
Doesn't sound good. So typically on delinquencies with these portfolios, we often see a very high rate of delinquencies, well into the double digits, on these legacy loan portfolios where there has been a significant gap in time and where students are they're not aware of their obligation or no one's contacted about their obligations. Usually a really good indicator that something has not gone well in that instance is that we'll often see an ACH relationship level which is down in the low single digits, like maybe even less than 1%. And that kind of really low level of ACH relationship tells you that essentially that no one's been minding the store. No one's been asking for those relationships. No one's been reaching these students to create those relationships. But usually you would find that even in the subprime arena, you should be well into the double digits on ACHs, and that would give you a kind of an anchor for the portfolio. For the newer refi student loans, it depends much more on the servicing practices of the originator. And we find that those originators which have a distributed servicing model where they're farming delinquencies out to collection agencies for what amounts to kind of one-off calls, the delinquencies are not as bad as many of the legacy portfolios, but essentially they could be better with a strong, steady hand on the servicing side.
Okay, and I have time for one more question that came in that basically asks, and this is really interesting, most of the student loan servicers grew up in the FFELP business. What is the typical pricing structure of FFELP versus private student loans?
That is an interesting question. Well, the student loan industry has certainly gone through some significant changes over the last 8 years. And I will take this moment to just say I'm sure it's about to go through some significant changes in the next at least 4 years as we expect the regulations to be somewhat more dynamic than they have been. So the FFELP program is an old program. And when you think about pricing between FFELP and private student loans, the answer is really it depends. It depends on a lot of different factors. For an old FFELP portfolio, that's essentially where all of the large student loan legacy providers do their business. So all the big players in that space, whether it be Sallie Mae or Nelnet, that's their industry, and their entire companies are geared up towards servicing those types of loans, which really leaves private student loans as a bit of a backwater in that sense, because it's still very true that 90% of student loans, give or take, are government loans. So with private loans being somewhat of a small, backwaterish kind of activity, that means that there's just been a lot less attention paid to what's really required to service a private loan in that space versus what's required to service a government loan, because government loans are where the largest part of the money is. So you'll find pricing differences between servicing on both sides and the newer private student loans, and I emphasize newer, would be priced much more like consumer loans, like traditional consumer loans that you would see coming out of the FinTech space today. Okay.
Well, thank you for a very informative webinar, and thank you to all of the participants who sent in questions. Again, just a reminder, you'll be receiving a survey if you would be kind enough to fill that out. That helps us with some additional topics. Please be on the lookout for a webinar in early January, which is going to discuss a year in review for marketplace lending and a year ahead for 2017. And again, thank you for dialing in today. Have a great day.
Thanks, Larry.